Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So I wanted to identify some of these through illustrations. And you can see here, if we take a look at the First Trust ISE Water Index Fund, notice how down along the bottoms here, it more or less came down towards the $17 area, and every time it got down to $17, it basically found a low, reversed, and actually rallied, found a low, reversed, and rallied, found a low, reversed, and rallied. So as these bottoms are being formed along that downside, we start to equate that $17 level is acting like support. And now, if you're just a traditional investor, one could consider buying on support levels as a buying opportunity. But otherwise, when you're an option writer, covered call writer, or you sell naked puts or cash covered puts, or even do put credit spreads down below, you want to make sure your put credit spreads are done below the support resistance lines. So that way, if you're wrong, it's because a support line gave out, and you know that you have to use a risk management technique for getting out of the trade. Again, and I think many of you can share that, but in fact, it's the most critical thing to do as a trader is knowing when to actually get out of your trade at a loss. So many investors somehow believe that if they study enough and they know enough and attend enough things, that they'll find a way to always be right on their trades and never wrong. And a sad truth of that is that's a serious misconception. In fact, even the best traders have losing trades. It's not about losing, it's about losing small when you're wrong. You have to have a method to know whether you're right or you're wrong on your trade. And what's nice about a support resistance line, like let's say the $17 level here on this chart, is that if you try to buy the water index fund down along that 17 line, where do you know you're wrong? Well, when it trades below 17. So how much did you really have to risk to find out you were wrong? Maybe 20 cents, 30 cents on the position? Well, if you're trading, if you're right and you catch that on the upside, that trade went from $17, up to $21 or more. And so what happens here is that you were able to try to capitalize on a very big move on the upside, and you only had to risk a small amount to find out whether or not you were right on that. But what's another technique we can use? Not just support resistance. We can actually draw a trend line, right? Even if you just connected the highs up along the upside of those highs and drew it off of those two key highs downwards. When that trend line broke on the upside, one could use that as a buying opportunity for taking that trade. Now, that was called support. There's also a methodology which you can use, and that's resistance. And resistance, while support is at the bottom, resistance is up above. And you can see up here this 45 to 47 area on the ISE Global Copper Index Fund. On this ETF, you can see that every time copper tried to rally up into those zones, it rejected. Literally, all of those highs up along there all came within $1 or more, just somewhere in that vicinity of that range. And so one could recognize that there's significant overhead resistance, and therefore one would want to take their profits into the overhead resistance, or two, you want to maybe short sell or buy puts to try to profit from the downside move of the ETF as it's reversing. So let's actually try to do some strategy implementation of directional trades. What we'll do is we'll put up a chart, and then we'll talk about some of the different things that one could consider when you're actually implementing the strategy. So in this situation, what we have here is the natural gas index fund, the ISE one, and we wanted to look at let's say connected the trend line along the three highs going lower. Notice higher highs, higher lows as it's moving down lower. And essentially, as it's moving down lower in that trend, we saw that it broke higher, and we wanted to wait for a little bit of a pullback in order to before we go and open new positions. So now, if you were to, let's say, use this little, what we in technical analysis call a little flag formation, what we're looking for is something off of a consolidation off these highs. What we're looking for is some support to come in. Notice where there were numerous previous highs and lows in the past that came in along this line. Notice that natural gas index fund reversed off of these previous highs and lows. And as it's doing that, what you're looking for is some sort of a signal that that candle or that market is breaking out. Now, if you see that it's actually technically making a break higher, you want to be, let's say, using call options to try to profit from a move. Now, if you don't necessarily have to wait till it's $18 to buy it. You could buy it sooner in this sequence. But the point is that we have a technical reason for believing that this ETF will continue to actually in its prior trend. Now, where would be reasonable places to consider taking profits on something like this? Well, notice that the previous highs all lie at the $18 and then subsequently $19 levels where short-term highs all came in. So what you're essentially doing is when you buy a call option here, you can use previous highs as overhead resistance and look to take your profits on your buying your call options into some of that overhead resistance. Recognize that what I just demonstrated was a simple, and I mean I'm talking simple methodology for making a technical decision. One could use an indicator, one could use moving averages, one could use any number of things to make this trade call, but it doesn't even have to be. But when that trade call occurs, notice how this is different than someone who uses fundamental analysis. Somebody who here believes that, let's say, natural gas will do well, in spite of all the big supply and everything, and therefore wants to be long those units. Well, the thing is that really, whenever that person chooses to buy from a fundamental perspective, how do they really manage when they're going to sell or how they're going to sell when they're doing it? And this is where technical analysis comes in, was we can determine not only where we want to get in and why we want to get in, but also then where we're going to get out. So now what I want to then do is look at it from a bull-call spread, which is essentially the same concept as buying a call, but we're doing it in a spread. And I want to familiarize everyone with a bull-call spread just because there's some people online here, I'm sure, that have never done one. But if you're using a bull call spread, what we're doing is we're buying a call option to participate, let's say, on the upside of the security, identical to what we just did on the previous example. We just bought a call option and we're trying to profit from the move higher. But in an attempt to reduce the cost of owning that call option, what we do is we sell another call option at a higher strike and collect an income for doing it, so that we reduce the cost of the option at the expense and we cut off some of the upside. So let's illustrate that here. So this is the identical situation, right? This is literally a spitting image of what we had. But what we do is we identify where those previous highs came in. Notice that this $19 level was where all the previous highs have occurred, and in doing so, we then, let's say, would sell a call option at the $19 strike. So you could either choose to do the $17 to $19 bull call spread, or you could do the $18 to $19 bull call spread. But irrespective, one is choosing to do that because really, in the end, you are only planning on trading this position up towards $19 anyway. So if you could reduce the cost of your call option by selling another call option and creating a spread, it mitigates some of the costs associated with just letting that option expire if you're wrong. So the next one I want to take a look at here is the idea of being bearish on something. So in this example here, we were looking at that natural gas index fund, and what we want to just point out is that when you have a previous support line down below here, one just simply needs to wait till the support lines are broken. So in this situation, as that natural gas is trading there, you're waiting for it to technically break, so it's making lower highs and lower lows, and you're looking for that to then continue on down to some to some new support resistance levels. And this is something that you want to be aware of, is that you don't want to wait for some sort of confirmation that in fact that a move is underway. Now, there's a question online. It's about whether this is a European style option or not, and how to manage that. First of all, the ISE index indices themselves are European-style settlement, which means that they only settle at on the last day on its expiration. But recognize you could buy and sell those options anytime you want, and so theoretically you can do that. And if you, let's say, hit your target within 3 or 4 days, you're going to have to pay some money to buy back the short option, but you're still going to be profitable because you have a net positive delta on the upside or a negative delta on the downside. But I just want to substantiate we're now talking about the new ISE ETFs, or exchange traded funds. And recognize that unlike the ISE indices and ISE currencies, which are European settlement, exchange traded fund options are actually American-style settlements. So you could theoretically, if you wanted to, exercise them anytime you want. So I just wanted that clarification made. Nonetheless, what we're looking for on this example is a breakdown signal to indicate that ISE natural gas index is actually broken and a new move on the downside is underway. Leon's just asking about what about moving averages. What I wanted to focus on here right now is the idea of just understanding trend and higher highs, higher lows, and breaks of that zone. It is not uncommon for traders to plot a number of moving averages to confirm these signals, or to use that as confirmation of these signals. And I certainly would not discourage anyone from doing that. As a technical analyst, I encourage all forms of technical analysis. The most important element of all in technical analysis is your ability to make an effective decision using that technical analysis, and that's very important along the way for you to learn how to actually make that decision. But in terms of my favorite moving averages, it actually all depends on the techniques. If you're using the moving averages only for trend identification, a 50-period moving average is sufficient. If you're using it for a moving average technique or a way of managing stop losses, you need to go to a faster 10, 20 period, or you can use a Fibonacci sequence ones like an 8 and 21 and so on. And Garth, to substantiate that, yes, using all of this with fundamental analysis is perfectly fine. Recognize that fundamentally good things tend to be the things that trend the best, because people are buying them because there's a reason for them to be bought. So there's nothing wrong with complementing technical analysis with fundamental analysis, but recognize that technical analysis gives you a means to make immediate decisions whether you're right or wrong, while fundamental analysis, that's a much more gray region. So on a breakdown here, on a break to a lower low, you can see that it almost creates like a head and shoulders formation or anything like that you can see up along the upside, and then subsequently reverses and breaks a neckline. So we have here a significant reversal of trend, and one would just, let's say, buy put options to try to capitalize on that. So if we wanted to, let's say, do a strategy called a bear put spread, and by the way, you can also, I'm using some option strategies here, but one could also just buy or sell the exchange traded fund. You don't necessarily have to use the options, but I'll tell you, once you become quite familiar with options, you don't go back. They offer a fabulous tool for risk management, for leverage, for generating consistent cash flow, and one wants to just simply make sure that you're using a strategy that you understand along the way for doing that. So a bear put spread is almost identical to the strategy we talked about for a bull call spread, but because the puts make money from the exchange traded funds going down, then you're actually trying to profit from forecasting a down move, hence the name bear at the front of the spread. And so what we're looking for is a way of profiting from this move down. And while you certainly, let's say, have the technical forecast that you, let's say, believe that that's going lower, one can reduce the cost of buying that put option by selling another put option along the way. So in this situation, what we do here is we put in a trend line, the same technical break, and we buy the puts, but we look at where there were previous highs and lows that were put in the past. And in this situation, at the $18 level down below was a place where, $19 level below was a place where there were previous highs and lows put in. And subsequently with that break, one could then turn around and actually sell a put option down over at that strike. Now what that allows you to do is to profit from the first put option down to that lower strike put, but you've cut off the downside potential below that short put or the sold put. Hence the name spread, because your maximum profit potential is only the spread between those two options. And so in this situation, if that's like a $19 to a $20 put debit spread, you have a $1 potential maximum potential payout for a $1 spread. So so I want to just touch on the idea of option writing and the use of option writing, and I'm a very big fan of option writing in general and collecting premium. When you sell options and collect a consistent premium, it allows you to make money off of neither being right nor wrong, just long as you're not really wrong on a position. Allows you to sit there and generate consistent returns along the way. But one of the most evident things within being a seller of options is that you need to understand support resistance, because you need to be able to sell option strike prices that do not have the likelihood of actually being hit.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.